Hello everyone, you are watching Fundamentals of Derivatives with Ravindra Hegde. Alright, let us move ahead and talk about functions of derivatives. One very important function that derivatives are expected to perform is financial derivatives help in facing financial risk arising due to change in prices, interest rates, and currency rates. Such instruments provide a commitment to price for future, thereby protect a party against future adverse movements. Friends, let us understand this concept through an example. Suppose in an international trade situation, you are an importer and you have recently made an import of the value US dollar 10,000. So obviously you are under obligation to settle that import bill on that invoice. Now this amount of US dollar 10,000 you have to settle, but not now. Say after 3 months, because supply has given you a free credit of 3 months, and obviously you want to utilize this credit, but you have a fear, you have a risk on your head. That is, today suppose the spot exchange rate of US dollar is INR 73. Statistically speaking, actual price as on today, that is 26th September 2020, is 73.7264. But for our example sake, let me consider as say INR 73. That means you require INR 73 to buy each US dollar today. But that rate is not going to remain same ahead. This rate is definitely going to fluctuate. US dollar have been priced on high volatility in recent time, what you have observed. As a result, to protect yourself, you have to do something. What you do is you approach a bank or an authorized foreign exchange dealer, and you go and negotiate with them. You tell them that you want to buy 1000 US dollar after 3 months from now, and you want to fix a price today. You want to commit a price today. So at present the spot rate is INR 73. The bank has agreed to supply dollar after 3 months at a little higher price, say INR 74 for US dollars. 74 for US dollars. Now you have a choice either to enter into forward exchange contract or not. So this contract is titled as forward exchange contract. So why you enter into this contract? It will give you protection. Why? Because after 3 months, irrespective of what is the rate for US dollar in forex market, you are still eligible to buy dollars at rupees 74, INR 74 only. That means your risk of adverse movement of dollar price have been taken care of. You are paying little more than what is prevailing now. Instead of INR 73, you are paying INR 74. You are agreed to pay a little premium, a little higher value on top of what is prevailing now. But you are still protected, because you will not be suffering with the fluctuation of the dollar price. As a result, risk on your head has been taken over. The question is, who take that risk? Obviously the counterparty. The bank has acted as speculator here. The bank has acted as speculator here. That means the bank will arrange dollars for you for any price of the dollar prevailing in the market that point of time. Bank will supply the dollars to you at a committed price of rupees 74 only. That is, your risk has been taken over by the bank. So what you find, if you try to name two parties involved over here, you as an importer but acting like a hedger. Sounds interesting? Hedger is a party who would want to shed away his risk in derivative market, and the counterparty, the bank, is acting as a speculator, because it is taking away your risk for making some gain for itself. As a result, friends, derivative market one side provides an opportunity to person like you to hedge their risk. On other side, it is providing an opportunity to parties like bank or authorized dealer to take risk and make gain for themselves. Friends, in this process, derivative market simply what it does is it takes away the risk of one party and places it on the top of the other. So the third function is financial derivatives also provide opportunities to make profit for those who are ready to bear a risk. In the process, derivative transfer the risk from those who want to avoid it to those who are ready to take the risk. The next point is discovery of price. Prices in an organized derivatives market reflect the perception of market participants about the future and lead the prices of underlying assets to the perceived future level. The prices of derivatives converge with the prices of the underlying at the expiration of the derivative contract. Thus, derivatives help in discovery of future as well as current prices. Next point, next function is, just look at the screen now. Risk transfer, we already discussed about this. Next is linked to cash markets. Derivatives, due to their inherent nature, are linked to the underlying cash markets. With the introduction of derivatives, the underlying market witnessed higher trading volumes because of participation by more players who would not otherwise participate for lack of an arrangement to transfer the risk. Next is check on speculation. Speculation traders shift to a more controlled environment of the derivatives market. In the absence of an organized derivatives market, speculators trade in the underlying cash markets, managing, monitoring, and surveillance, managing, monitoring, and surveillance of the activities of various participants become extremely difficult in these kinds of mixed markets. So let us move ahead on to the next function, that is encourages entrepreneurship. An important incidental benefit that flows from derivatives trading is that it acts as a catalyst for new entrepreneurial activities. See, derivatives have a history of attracting many bright, creative, well educated people with an entrepreneurial attitude. They often energize others to create new business, new products, and new employment opportunities, the benefit of which are immense. And next function, if you are talking, is encourages entrepreneurship is done, and also it increases savings and investments. Derivatives markets help increase savings and investments in the long run. The transfer of the risk enables market participants to expand their volume of activity. Friends, now let us move ahead about participants in the derivative market. Let us talk about derivative market participants. Generally, the participants may be classified into hedgers, second speculators, and arbitrageurs. The hedgers and speculators we already discussed now, and also we have discussed these things in forex also. I hope arbitrageurs is the new word to you. Who are hedgers? Hedgers are the parties who avoid risk by incurring cost, and speculators are the parties who make profits by taking risk, and arbitrageurs are the parties who make profits without taking risk. So hedgers are the parties who avoid risk by incurring the cost, and speculators are the parties who make profits by taking the risk. See, in the previous example, just what we have discussed, you are the hedgers and bank is a speculator, and arbitrageurs are the parties who make profits without taking a risk. Friends, now let us talk about main users of derivatives. The first user is the corporation. The purpose is to hedge currency risk and inventory risk. Second user are the individual investors. The main purpose is for speculation, hedging, and yield enhancement. Next user is institutional investor, and the reason is for hedging asset allocation, yield enhancement, and to avail arbitrage opportunities. And next are the dealers. Uh, Dealers are the main users again for hedging, position taking, exploiting inefficiencies, and earning dealer spreads. So, corporation, individual investors, institutional investor, and dealers are the main users of derivatives. Friends, no need to write down these issues. Okay, afterwards I will send the PDF if you want. Next, let us talk about the cash market and the derivative market. the difference between the cash market and the derivative market. In cash market, tangible assets are traded, whereas in derivative market, contracts based on tangible or intangible assets like index or rates are traded. Second difference, in cash market we can purchase even one share, whereas in futures and options minimum lots are fixed. You will come to know pretty soon the about the minimum lots and all in the next topic when we are discussing about futures and options. Cash market is more risky than F&O, futures and option segment, because in futures and option risk is limited up to 20%. The risk is limited up to 20%, but in cash market there is no limit, so there is a more risky. Cash assets may be meant for consumption or investment. Derivative contracts are for hedging, arbitrage, or speculation. Now you already understood the meaning of hedging, arbitrage, and speculation. The value of derivative contract is always based on and linked to the underlying security. However, this linkage may not be on point to point basis. In the cash market, a customer must open security trading account with a securities depository, whereas to trade futures, a customer must open a future trading account with a derivative broker. That's a quite interesting matter. And buying securities in cash market involves putting up all the money upfront, whereas buying futures simply involves putting up the margin money. No need to make a big investment. You have to pay a small amount, that's called as margin money. And finally, with the purchase of shares of the company in cash market, the holder becomes part owner of the company, while in future it does not happen. Now let us discuss about uses of derivatives. The first one is risk aversion tools. What is the meaning? Risk aversion tool. One of the important services provided by the derivatives is to control, avoid, shift, and manage efficiently different types of risk through various strategies like hedging, arbitraging, spreading, etc. Derivatives assist the holders to shift or modify suitability, the risk characteristics of their portfolios. Friends, these are specifically useful in highly volatile financial market conditions like erratic trading, highly flexible interest rates, volatile exchange rates, and monetary chaos. Next, second use, prediction of future price. Derivatives serve as a barometer of the future trends in prices, which result in the discovery of new prices both on the spot and future markets. Further, they help in disseminating different information regarding the future markets trading of various commodities and securities to the society, which enable to discover or form suitable or correct or true equilibrium prices in the markets. As a result, they assist in appropriate and superior allocation of resources in the society. Next point is the enhance liquidity. As we see uh, in the derivatives trading, no immediate full amount of the transaction is required, since most of them are based on margin trading. As a result, large number of traders, speculators, arbitrators, operates in such markets. So derivatives trading enhance liquidity and reduce the transaction cost in the markets for underlying assets. Next is assist the investors. The derivatives assist the investors, traders, and managers for large pools of funds to devise such strategies so that they may make proper asset allocation, increase their yields, and achieve other investment goals. The next point is integration of price structure. So it has been observed from the derivatives trading in the market that the derivatives have smoothened out price fluctuations, squeeze the what do you say price spread, integrate price structure at different points of time, and remove gluts and shortages in the markets. Next, catalyze growth of financial markets. The derivatives trading encourage the competitive tradings in the markets. Different risk taking preference of the market operators like speculators, hedgers, arbitrators, traders, etc., resulting in increase in trading volume in the country. They also attract uh, young investors, professionals, and other experts who will act as catalyst to the growth of financial markets. Next point brings perfection in market. Finally, it is observed that derivatives trading develop the market towards complete markets. Uh, Here, complete market concept refers to that situation where no particular investor can be better off than others, or patterns of returns of all additional securities are spanned by the already existing securities in it, or there is no further scope of additional securities. Still, we have some critics of derivatives also. The first critic is speculative and gambling motives. Speculation has become the primary purpose of birth, uh, existence, and growth of derivatives. Sometimes these speculative buying and selling by professionals and amateurs adversely affect the genuine producers and distributors. Friends, most of the speculative activities are professional speculation or moment trading, which lead to destabilization in the market. Next critic is increase in risk. It has been observed that the derivatives market, especially OTC markets, as particularly customized, privately managed, and negotiated, and so they are highly risky. Instability of the financial system. The fears of micro and macro financial crisis have caused the unchecked growth of derivatives, which have turned many market players into big losers. Friends, the malpractices, disparate the behavior and fraud by the users of derivatives have threatened the stability of the financial markets and the financial system. Next critic is price instability. The derivatives may be helpful in price stabilization only if there exists a properly organized, competitive, and well regulated market. Further, the traders behave and function in professional manner and follow standard code of conduct. Unfortunately, all these are not so frequently practiced in the market, and hence the derivatives sometimes cause to price instability rather than stability. Displacement effect. There is another doubt about the growth of the derivatives, that they will reduce the volume of the business in the primary or new issue market, specifically for the new and small corporate units. It is apprehension that most of investors will divert to the derivatives markets. Raising fresh capital by such units will be difficult, and hence this will create displacement effect in the financial market. Increased regulatory burden. As we see, uh, various financial crisis and scams in the market from time to time, most of the time, and energy of the regulatory authorities just spent on to find out new regulatory, supervisory, and monitoring tools, so that the derivatives should not lead to the fall of the financial system. Friends, today we have talked about functions, the participants, the difference between cash market and derivative market, and users and the critics of the derivatives. Thank you. Have a nice time. Thank you so much again.